First of all, I wanted to mention, you talked about how there's no coverage at all in the media of the gold rise. I mean, you might not expect it in conventional, news, but you might expect that the financial news would be covering it, and they're not. They completely ignore it. I mean, maybe because now too, it's making a record high almost every day. That it's like, there's nothing new about it. But when gold is doing this is very significant. I mean, this is sending a clear signal that the Fed is making a mistake, that the rate cuts are a mistake, that inflation is going to be a lot higher, and they're ignoring those warning signs. Part of it is because of the distraction about Bitcoin. I mean, I'll be watching on financial news, and gold will be making a new high. And not only will they not talk about gold's significant new high, they'll go on and on about Bitcoin making a new, 1 month high. Even though Bitcoin peaked out in terms of gold almost 7 months ago. It was in March of this year. Bitcoin is down about 30% priced in gold. So to me, it seems like Bitcoin's in a real bear market because gold is not just, it's not just the dollar that's going down in terms of gold, it's Bitcoin too. And the Dow is negative this year in terms of gold. It's hard to find. There's a few NASDAQ stocks and things like that have gone up, but a lot of that has to do with speculative mania, bubbles that are going on that have bid up these prices. But yeah, you have a complete absence of coverage, and not a lot of people are buying. We have Schiff Gold as my gold company. Business is pretty slow. It hasn't picked up. If you look at the ETFs, there have been net liquidations this year out of gold ETFs. The public is selling. And so if the public is selling, who's buying? I mean, somebody's got to be buying. It's mostly foreign central banks because they're trying to replace their dollars. And they're trying to replace it with real money, and they got a long way to go because they still have a lot of dollars to unload. But imagine what's going to happen to the price of gold when the central banks have to compete with private investors. Not just individuals, but the big guys, pension funds, hedge funds, mutual funds. What happens when real money tries to get into the gold market? I put out on my X today. I have over 1 million followers. You should follow me on X if you don't do it. But I noticed that MicroStrategy now, which has been on a tear, it's at a new 52-week high. It's now got a larger market cap than every gold stock in the world, with the exception of Newmont. And it may pass Newmont, despite the fact that it has no earnings, it's losing money, and it makes nothing. There's a software business in there somewhere, but it's a small fraction. All it is a leverage play on Bitcoin. Yet, it's worth more than Barrick Gold. Which is the number 2 gold company in the world. So that the public is distracted by what's going on in that casino, and they're missing out on the real significance of what this means. Because the increase in gold's market cap, that dwarfs the entire market cap of Bitcoin. Gold going up is a lot more significant than some string of numbers that people are gambling on, which will ultimately collapse.
The lack of media coverage on gold's recent rise is striking, especially considering the significant implications this has for the broader economy. One would expect at least the financial press to cover such developments, but instead, we see an almost deliberate silence. The mainstream financial media, distracted by speculative narratives surrounding Bitcoin and other digital assets, has largely ignored the new highs in gold prices. This is despite the fact that gold's rally is a loud and clear signal about the Federal Reserve's policy missteps, the rising inflationary pressures, and the erosion of fiat currency's purchasing power. Instead of focusing on gold's historic movements, financial news platforms often highlight Bitcoin's comparatively insignificant rebounds. For example, while Bitcoin might experience a minor rally, gold continues to break records, yet it goes unnoticed. Bitcoin's valuation, when adjusted for gold, has plummeted in the last year, down over 30% when priced in gold. This demonstrates that gold is not just outperforming fiat currencies, but is also solidifying its dominance over speculative assets like Bitcoin. However, speculative hype keeps much of the attention on digital assets, obscuring the real story, the steady ascent of gold. The Dow Jones, another traditional barometer, is negative this year when measured against gold. Even though certain NASDAQ stocks have performed well, their success is often linked to speculative bubbles or fleeting media narratives. The average investor is distracted from understanding gold's critical role in preserving wealth. Public interest in gold remains subdued, with liquidations from gold ETFs and sluggish retail demand being common. At Schiff Gold, even during gold's recent surge, business activity hasn't dramatically increased. This suggests that private investors are not yet fully engaging with gold, leaving much of the demand to foreign central banks. The disparity is clear. While the general public remains hesitant, foreign central banks are actively buying gold to diversify away from their dollar reserves. These institutions understand that real wealth lies in tangible assets like gold. Many of them are using gold to replace their excessive dollar holdings. This shift reflects a broader de-dollarization trend, where nations seek to insulate themselves from U.S. monetary policy and the risks associated with dollar-denominated assets. This raises a critical question. What happens when private investors, including institutional players like pension funds, hedge funds, and mutual funds, start competing with central banks for gold? The potential influx of private capital into the gold market could send prices soaring. For now, central banks are the primary buyers. But once broader market awareness takes hold, the demand for gold could skyrocket. On social media platforms like X, formerly Twitter, Peter Schiff highlighted the discrepancy between gold's importance and the market's misplaced priorities. For instance, MicroStrategy, a company primarily leveraged to Bitcoin, now has a larger market cap than almost every gold mining company except for Newmont. This irrational exuberance over Bitcoin reflects how speculative mania overshadows fundamental value. Despite its lack of earnings or significant underlying business, MicroStrategy is valued more than Barrick Gold, the second largest gold miner globally. This absurdity underscores the public's neglect of tangible assets like gold in favor of speculative digital tokens. The broader implications of gold's rise extend far beyond its market cap. Gold's increase dwarfs Bitcoin's total valuation, reflecting a tectonic shift in global financial dynamics. Gold represents stability, trust, and enduring value, qualities sorely lacking in speculative assets. As gold continues to rise, it becomes evident that this is more than just a commodity rally. It's a reflection of systemic issues within the global economy, particularly the declining faith in fiat currencies. Gold's performance is particularly notable given the geopolitical context. The easing of geopolitical tensions, such as Trump's promise to end the Ukraine war within 24 hours of his election, briefly caused a dip in gold prices. However, the underlying structural issues in the global economy suggest that this was a temporary correction. The fundamentals supporting gold remain robust, with the next leg of its rally likely to take prices well above $10,000 per ounce in the coming years.
Gold goes back up. Let's see, it closed at $2,668. Again, 2 weeks before the election, we've been saying it on the air as well for weeks. We wrote in the Trends Journal that gold has to go down at least 200 points. It had a straight run up. And then the Trump coming in and Trump's promising that he would end the Ukraine war in 24 hours when elected. Let's see. That's what brought gold down, part of it, because of the geopolitical tensions eased. That's a fact. And that's one of the reasons why gold is going up now, because geopolitical tensions are increasing.
But I think we're now early in the next leg up, which is going to take the price of gold to many multiples of its, current price, well north of $10,000. What we're witnessing is the collapse of the dollar, and not just the dollar, the euro, the yen, the pound. I mean, all these central banks have got themselves into this box where they kept interest rates at zero or in some cases negative and, enabled massive deficit spending for governments around the world. And now we're going to, have to deal with the consequences of that massive inflation that has been unleashed. And you're going to see it most dramatically in the price of gold, because you're not actually looking at the price of gold. You're looking at the price of currencies collapsing against real money. When America didn't have a central bank and we were on a gold standard, the price of gold was constant. It was $20 an ounce in 1789, and it was still $20 an ounce in 1913 when we created the Fed. So the dollar was able to buy the same amount of gold in 1913 as it did in 1789. In 125 years, the dollar maintained its value. Then Roosevelt devalued in 1933, and now you needed $35 to buy an ounce of gold. And that was the same, although it was artificial because we started printing a bunch of money, especially in the 60s. But we went off the gold standard in 1971. But now we've gone from $35 to $2,700. Gold hasn't changed. Gold is exactly the same as it was in 1789, right? When we had the first Coinage Act and we defined the dollar as a weight of gold. What's changed is the value of the dollar that the governments create. And gold is just showing you that dollar's collapsing. The dollar has already lost more than 99% of its purchasing power since the country was founded. So that means you need more than 100 times as many dollars to buy things that, other than, what we would have paid if we hadn't debased the dollar. And that's why the standard of living has gone down for a lot of people in this country. That's why Trump, is as popular as he is again, and why he won for the first time was because people are upset that they have to work 2 or 3 jobs and they still can't pay the bills. So they have record credit card debt because the value of the money is being destroyed. And that inflation tax is how the government is now funding.
The narrative surrounding gold's recent rise extends far beyond just economics. It is a commentary on shifting geopolitical dynamics, systemic economic vulnerabilities, and the public's growing frustration with traditional financial systems. The muted coverage of gold in mainstream media is not only surprising, but indicative of a broader trend. The deliberate sidelining of conversations that challenge the prevailing financial orthodoxy. As central banks, institutional investors, and forward-thinking individuals quietly accumulate gold, the stage is being set for a monumental shift in the way global wealth is stored and preserved. Gold's rally, contrary to popular belief, is not merely a reaction to inflationary pressures or the Federal Reserve's monetary policies. It is a culmination of multiple factors converging, including the de-dollarization movement, central bank accumulation, and the increasing awareness of fiat currency vulnerabilities. The public, however, remains largely unaware of these shifts, distracted by speculative bubbles in assets like Bitcoin and tech stocks. This disconnect creates a unique opportunity for informed investors to position themselves before the broader market catches on. The idea of gold surpassing $10,000 per ounce by 2025 might seem ambitious, but it is grounded in historical precedents and current trends. During the 1970s, as the U.S. grappled with soaring inflation and economic turmoil, gold experienced a meteoric rise, climbing from $35 to $850 per ounce. Adjusted for today's inflation and monetary expansion, such a rise would put gold well into 5-digit territory. Similarly, silver, which often follows gold's lead, but with greater volatility, could see its price break past $75 or even $100 per ounce. Silver's dual role as a monetary and industrial metal, especially in the context of green technologies and renewable energy, positions it for exponential growth. The role of central banks in driving gold prices higher cannot be overstated. Over the past decade, central banks have been net buyers of gold, reversing a multi-decade trend of selling. This shift reflects a growing recognition of gold as a hedge against geopolitical uncertainty, economic instability, and the declining dominance of the US dollar. Nations like China, Russia, and India have been particularly aggressive in building their gold reserves, signaling their intention to reduce reliance on the dollar-centric financial system. This trend is further amplified by discussions around a potential gold-backed currency, particularly among the BRICS nations: Brazil, Russia, India, China, and South Africa. The idea of a new reserve currency pegged to gold and potentially other commodities represents a direct challenge to the dollar's status as the world's primary reserve currency. Such a move would not only elevate gold's importance in international finance, but also significantly impact its price as demand surges. A gold-backed currency would offer a level of stability and credibility that fiat currencies lack, especially in an era where central banks are printing money at unprecedented rates. The adoption of blockchain technology to audit and verify gold reserves could further enhance transparency and trust in such a system. By tying their currency to gold, nations could mitigate the risks associated with fiat money while providing a tangible foundation for their economies. For investors, the implications of these developments are profound. As central banks continue to accumulate gold, the available supply for private investors will shrink. This scarcity, combined with rising demand from individuals and institutions, could create a perfect storm for higher prices. Pension funds, mutual funds, and hedge funds, which currently have minimal exposure to gold, could significantly impact the market once they begin reallocating their portfolios toward precious metals. The public's current indifference to gold is both a challenge and an opportunity. While retail demand for gold remains subdued, the potential for a sudden surge in interest is enormous. Historically, gold has performed exceptionally well during periods of economic uncertainty and inflation. As these conditions become more pronounced, more investors will likely turn to gold as a safe haven asset. Silver, often referred to as poor man's gold, offers an equally compelling investment case. Its price is currently undervalued relative to gold, with the gold-to-silver ratio far exceeding historical norms. As industrial demand for silver increases, particularly in solar panels, electric vehicles, and other green technologies, this ratio is expected to normalize, driving silver prices higher. The combination of monetary and industrial demand creates a unique opportunity for silver investors to benefit from both rising prices and increased market interest. Looking ahead, the interplay between gold and silver will be critical. While gold often leads the way in bull markets, silver tends to outperform in percentage terms once the rally gains momentum. This dynamic reflects silver's smaller market size and its dual role as both a monetary and industrial asset. For investors, this means that a well-balanced portfolio should include exposure to both metals, leveraging their complementary strengths. The broader economic context also supports the case for gold and silver. The global debt burden, already at record levels, continues to grow, with governments relying on monetary expansion to finance deficits. This unsustainable approach is eroding confidence in fiat currencies and driving investors toward tangible assets like gold and silver. Moreover, rising geopolitical tensions, from the conflict in Ukraine to growing friction between the US and China, add an additional layer of uncertainty, further boosting demand for safe haven assets. In the short term, gold and silver may experience volatility, particularly as markets react to Federal Reserve policy decisions and economic data. However, the long-term trajectory remains firmly upward. The structural issues underpinning the global financial system, from excessive debt to declining trust in institutions, are not easily resolved. As these challenges persist, gold and silver will continue to serve as essential hedges against economic and geopolitical risks. In conclusion, gold and silver are not merely investments. They are strategic assets that offer stability, security, and enduring value. Their rising prices reflect deep-seated issues within the global financial system and highlight the need for a more sustainable approach to economic management. For investors, the current environment presents a unique opportunity to capitalize on these trends, positioning themselves for the next phase of the precious metals bull market. As we move toward 2025, the case for gold and silver becomes increasingly compelling. Whether as a hedge against inflation, a safe haven in times of crisis, or a cornerstone of a diversified portfolio, these metals offer unparalleled benefits. In a world of uncertainty, they remain a beacon of stability, providing investors with the confidence to navigate an ever-changing landscape.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.